Good morning and welcome to the ADS Securities Markets Update. We'll start today with a look at the latest developments in the US, and then we will have a look at the Asian session in addition to an overview or a preview of the upcoming session during the European session and the US session. But beginning with the US, the economic figures came in with mixed outcomes yesterday. First of all, for the inflation figures, the month-over-month CPI posted the biggest monthly decline since 2008, or basically since the crisis, declining by the third month in a row, which basically also not seen since the financial crisis in 2008. However, the core CPI surprised basically with an increase of 0.2% in January, while the estimates were to rise only by 0.1%, which is the biggest monthly increase since October of last year. In addition to that, the year-over-year CPI, which is the most negative number in yesterday, declined for the first time, or posted the first negative reading since the crisis in 2008, declined by 0.1%, down from 0.8%. And finally, the year-over-year core CPI stabilized at 1.6% for the second month in a row, as widely expected. However, the durable goods also came in with mixed outcomes. First of all, December's readings has been revised down even lower, toward minus 3.7% instead of minus 3.4%, while the orders also increased in January by 2.8%, which is also the biggest monthly increase since July of 2014 or last year. The core durable goods order also came in less than expected, rising by only 0.3%, while the estimates were to rise by at least 0.5%. Moreover, December's reading has been also revised lower, toward minus 0.9 instead of minus 0.8%. Finally, in the US, also again, the initial jobless claims spiked above 300,000, again toward 313,000, up from 282, while it had been anticipated again to remain below the 300,000 mark, around 290. The US dollar surged across the board yesterday on the back of the core CPI, a positive surprise, in addition to the durable goods order, which also again rose by 2.8% in January. However, today's GDP will be the key, as there are many signs right now that Q4 GDP may disappoint again, especially after the downward revision in December's reading for the durable goods. As for the Asian session today, we had many economic releases from Japan, which also came in with another surprises and keeps the outlook negative there. Basically, first of all, the household spending crashed by the most since September of last year, declining by 5.1%. And in addition to that, the jobless rate, or the unemployment rate, posted the first increase in almost more than 4 months, rising toward 3.6%, up from 3.4% during the month of January, which is the highest jobless rate since July of last year, since September of last year, 2014. The retail sales also came in with another disappointment, declining by 2%. Which is also the biggest monthly decline since April of last year. The inflation, or as for the inflation figures, first of all, the national core CPI is also slowed down toward 2.2%, down from 2.5%, which is the 8th monthly slowing down in a row, and the lowest reading since March also of last year. The good news from Japan came in only from the industrial productions figures, basically, which increased again by the most since June of 2011, rising by 4% during the month of January, and this is the second monthly increase in a row. Going forward to the European session ahead today, all eyes will be on the inflation data from Germany, Spain, and Italy. And if you look at the numbers, first of all, in Germany, the CPI is expected to rise first of all by the most since January of 2013, by 0.6%, after declining by 1.1% last month. In Spain, the deflation is likely to deepen further, and the year-over-year CPI is expected to decline toward minus 1.5%, down from minus 1.3%, which would be the biggest monthly decline on a record. Finally, from Italy, the CPI is expected to rise by 0.2%, comparing to a decline of minus 0.4% in January, which would be again the biggest increase since August of last year. As for the US session, or the final session for today, or for this week, we'll be waiting for a collection of economic releases as well, and including the second estimates of the GDP, or the fourth quarter GDP of last year, in addition to the Chicago pending home sales and the revision or the revised reading of the University of Michigan Consumer Confidence. But first of all, the prelim GDP, or the second estimation, is expected to be revised even lower, toward 2%, and this is ADS Securities estimates, while the market is expecting around 2.2, 2.1%. In addition to that, Chicago PMI is expected to come in even lower toward 58.4. The pending home sales expected to rise by 2.5%, and finally the revised University of Michigan is likely to be even revised even lower toward 94.2, down from 98.1. However, the major impact is likely to come in from the GDP revision. The estimates again aren't optimistic that much or as much for the Q4 GDP, especially after the revision from the durable goods orders. But the last thing that we're talking about, or the technical chart that we will mention again, this is the Kiwi dollar that we mentioned yesterday. The price or the pair was trading around 75.71. However, the rally continues during the day toward, or continue to trade within the selling area that we noted since the beginning of the week between 75.33 and 76.18. It continues within the same range. Yesterday we topped out at 76.18. However, yesterday's high was about 76 or almost 76.14. So we're almost only 4 pips away from our second short area. However, we'll keep the negative view for the time being, with the stops again above 78.90, which is the top of the recent decline, and will continue to short the rallies in the next few days. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube, to get the latest economic releases, reports, and analysis. Thank you for watching. I'll see you once again next week.